Thanks for the time in this afternoon session. I was afraid for a bit that we were not going to get a crowd, so I'm quite happy that we have a few people in the audience. I guess just to start off with, the background, I think, of what we're trying to achieve, or what we are trying to achieve with this non-linear derivative paper, very similar brief to the linear derivative paper. So in other words, the objective function is to set some form of standardized convention, for the derivative market on that front. I think it's worth maybe just starting off with a bit of introduction. So I'll just go through some of the names and a bit of a brief introduction on each of the persons. So I'll start off with Professor Tom McWalter, who's sitting on my left. He's an applied mathematician, lectures in the computational finance in the Master of Financial Engineering program, which is offered by the African Institute of Financial Markets and Risk Management, and that's colloquially known in industry as the AFRIM program at UCT. His research interests include numerical methods in finance, modeling and pricing, and derivative instruments. He also holds an MSc in mathematical finance and a PhD in computational and applied maths. To Tom's left, we've got Peter Venter. He's a seasoned interest rate derivatives trader at RMB. He's got close to 10 years of experience market making interest rate options, as well as extensive experience trading South African government bonds and linear derivatives. And Pete holds a master's in quantitative risk management from Northwest University. To Pete's left, Obaid Mohammed is the head of quant analysis at ABSA CIB. Prior to this, he was a full-time academic within the AFRIM program as well, and Obaid has a PhD in quant finance. And to Obaid's left, it's Linesh Mudlia. He's the head of quantitative modeling at Libfin. Substantial amount of experience in pricing and hedging derivatives. Linesh specializes in interest rate modeling using valuation of long-dated embedded guarantees. Linesh is also a chemical engineer and has a master's in maths of finance as well from UCT. And I guess lastly, I'm Ajay, your panel moderator. I think we've done the intros on my side already from the previous session. But I think the reason why I wanted to highlight, I think, just the vast experience and academic qualifications of the panel here is that, and I wanted to make a point that there's a significant amount of, I guess, academic power behind the paper, as well as then a significant amount of practical market dynamic that's been placed into the paper as well on that front. I'm hoping you can see some of those dynamics being teased out during the session. But with that said, perhaps let's get cracking with the agenda on this front. So we won't spend too much time on this particular piece of information. I think it's, to a large extent been called out in many of the previous sessions. I guess the one thing I do want to call out on this front here is obviously from a nonlinear derivative convention perspective. We are going to be publishing this paper. I think if you are attending this conference, that should be in your inbox as of this morning in terms of the paper. It's likely to go through a consultation and comment phase on that front. And much like the linear derivatives process, this is going to result in probably some test trades that take place interbank, just to test whether there's any unintended issues that perhaps pop up with the conventions that we've set forth. I think this market's perhaps slightly less complicated in the sense of infrastructure. To a large extent, well, actually, I don't think non-linear derivatives actually clear through LCH at all. And so on that front, from a committee and derivative workstream perspective, we don't have to go through that loop of getting this particular product onboarded on LCH, which actually took up quite a bit of time from a derivative workstream perspective. I'd like to then hand it over to Obaid, to maybe just give us a bit of a preamble in terms of what the nonlinear derivative market then looks like globally.
Yeah, sure. So I think in short, we have here a picture of gross notional outstanding. On the left side, you'll see globally, there's about $715 trillion, I think, of gross notional outstanding on derivatives, OTC, and around 80% of that is linear derivatives, or rather interest rate derivatives. So of course the bulk is linear derivatives, which really spurred on the need to create conventions for the linear market first. Then 8% of that, or about $45 trillion, is nonlinear derivatives. And yeah, which is why I think it's also natural for the linear derivative market conventions to be set first before the nonlinear versions were set. And then on the right-hand side is just a sort of summary of exposure on different products in the South African market. And I think it's quite obvious that the main derivatives to focus on is caps, floors, and swaptions, which is why that was the focus of the nonlinear derivative paper.
Thanks, Obaid. So before we delve into the conventions, I think it's worth getting a look and feel into the practical dynamics of the market. So Pete, given that you are at the coalface in terms of market making these instruments, perhaps give us a sense of what this market looks like, and perhaps the underlying dynamics that perhaps everyone else is not used to sort of observing on that front.
Sure. So the South African interest rate options market essentially includes a product suite of 4 products. So we've got swaptions, caps and floors, and then we've also got bond options that you can trade both on a exchange traded or OTC basis. The product set basically gets used by everyone. Corporates use it as an alternative way to hedge exposures, as an alternative to swaps. Hedge funds and institutions use it as portfolio overlays or a way to gear reviews that they have. And then you've also got CVA and XVA desks who manage funding and credit exposures via the product. The product is pretty liquid. I think so liquidity is something that evolves and not something that you can take for granted, something that you have to look after. But Rand interest rate vol, over time is probably the 4th most liquid rate vol currency in the world. So only after basically G3. So we're more liquid than something like Aussie dollar or Swissy or any of the Scandinavian currencies. And then maybe just a nuance that we could probably use as a bridge a little bit later in the discussion is that what we trade, i.e. what we quote to clients and on broker screens at the end of the day is a price. So it would either be a Rand premium amount or a basis points of notional amount. I think we can leave it at that.
Thanks, Pete. So I think just for everyone to view, I think we've just put a bit of a snapshot in terms of the broker quotes out there just to demonstrate the point Pete made. I think the top right is on premium or price, but the market obviously keeps track of volatility on 2 fronts as well, and we'll delve into some of those dynamics as well. Pete, maybe just sticking with you, I think one of the interesting dynamics and certainly this was a surprise to me, is the underlying assumption under which vols are quoted. So in other words, with respect to that screen that we see in front of us, it is a case that all of those prices assume an underlying dollar CSA assumption. Can you give us a sense of perhaps why this is the case, please?
Sure. So options are not cleared like swaps and SPSs are. Options are OTC. So in an OTC market, you need to post collateral, and then to convert a premium or a price to a vol, you need an assumption of what the base collateral is. In order for any market to work, I think it's really important that you pick the convention which makes interbank the interbank market as seamless as possible, since that's basically the main vehicle where you offlay risk. It's not uncommon. For instance, it happens in the Scandinavian currencies. They have Euro CSA as the underlying base collateral currencies. In something like Aussie dollar, they have USD CSAs as the underlying base collateral currency. So in Rand, we've chosen dollars to be the base collateral currency. And that is just so that when you go into a broker and you see a price and you decide to trade on it, the stuff you need to agree essentially is the strike and the size. And then you need to pass a name and see if that's good on credit. You don't then, so the CSA adjustments are punitive on a relative basis. So I'd kind of say we've picked the convention that distorts the interbank market, as least as possible.
Thanks, Pete. Obaid, maybe back to you. Just this overnight risk-free rate regime or overnight rate regime, I guess, brings a new dimension in terms of the manner in which, certainly from a linear derivatives perspective, the way derivatives reset. But I'm sure that, brings some kind of, I guess, complexity to nonlinear derivatives as well. Can you maybe just give us a sense just of the resetting mechanism, as it's going to be applied within the overnight risk space, please? Overnight rate space.
Sure, yeah. We can start with this graph on screen now. So I think what's showing on this graph, firstly, is the repo rate, which is, of course, the policy rate, and it moves in let's say, a predictable way, because it only changes upon an MPC decision point. Then we have Zeronia, which you can see follows closely, but is below that because it's really a bid rate. And then we have 3-month compounded Zeronia, which we can think of as the analogous rate to compare JIBAR to because of the accrual period being 3 months for the main reference tenor of JIBAR in South Africa. And I think what's quite striking to take note of just from a more technical modeling perspective is that we have fundamentally now a reference rate that moves in a very rigid type of way. It can jump on a MPC decision point or maybe an unexpected one. And then we have somewhat of a forward rate, which is based off compounded Zeronia, which transitions or its dynamics is a lot more smooth. So these are interesting new challenges whereby we didn't really have to think so deeply about this in the JIBAR term-based world where everything was kind of diffusive in the way that JIBAR evolves. There are jumps, of course, but in general, it was a lot more dynamic than the dynamics of an overnight Zeronia point. We can go to the next slide. And then I think fundamentally or very practically, the main thing that most of our conventions have had to try and resolve is the impact of having a term rate, which we know at the beginning of an accrual period. And now we have a compounded rate, which is also referred to as a backward-looking rate. And we only truly know the final compounded value at the end of the accrual period. So the biggest impact this has had is on settlement, obviously. And you'll see, I'll speak a bit later about how we've solved for the settlement problem of only knowing what an interest rate cash flow is at the end of an accrual period. And then just to, I guess, market a paper that we've produced previously, these two pictures come from a guide that we put together post the creation of the convention paper for linear derivatives. And it shows you practical examples of these conventions with some very practical real-world examples as well. So if anyone's interested, they can look at that. Yeah.
Great, thanks, Obaid. So I think we've set, a nice background, on these nonlinear derivatives. And with that said, I think we can start delving into the conventions. So Linesh, maybe over to you, just in terms of the conventions. I certainly think, in terms of the process in which these conventions, were set, the time in which it took to actually get broad agreement on this was actually quite substantial relative to, the previous work that we did on the linear side. Linesh, maybe just give us a summary of the key conventions, if you don't mind, as well as then perhaps reflect the underlying tensions, within the actual working group in actually coming in finalizing those conventions, please.
Yeah, sure, Jay. So we'll start with the caps and the floors, and that can be further broken down into the caps and the floor, so the captors and the floor lids, and then we broke it down into spot starting caps floors and then forward starting caps floors. So if you take the caplet, you don't have an accrual period, and so you don't have a single accrual period for the caplets or floor lids, compared to a series of accrual periods for the caps and floors. So looking at the conventions on the table, we have 3 months accrual periods across the instruments, and then we have the forward period, which is the preceding period before the accrual period. And so if we look at the conventions, it's less than 21 months for caplets and floor lids, and then jumping to the forward starting caps and floors, that's less and equal to 10 years. Right. And then we have the option tenors. So just to note that option tenor for the caplets and floors, it includes the forward period as well as the accrual period. So that's less than equal to 24 months. All right, so the caps and floors do inherit many features from the overnight index swaps. So as Obaid was referring to that paper, you'll find that many of these conventions is actually consistent or the same as the linear derivatives paper. So I'm just going to run through them. So the spot lag refers to the lag at the end of the forward period to the start of the accrual period, and that's 0 business days. We have the South African calendar, which is Zacha, and then we have the business day convention, which is modified following the accrual day generation, which is backward end of month, actual 365 fixed. And then we have this, the annualized cumulative floating rate, the ACFR, and that's applicable for the accrual period. And so the calculation there would be compounded and represented as simple with 6 decimal places. And then just speaking to your point, Jay, what we've highlighted the conventions that received a lot of conversation and discussion in the workstream sessions, and specifically the benchmark CSA, which is USD, and the assumption there would be a 0 threshold collateral with SOFR as the collateral rate. And I think Pete has kind of highlighted for the reasons there. The premium type would be spot, and the premium lag being 2 business days, and that's so premium paid 2 business days after transaction. And then the market quote convention, there's 3 types. There's the premium, as is discussed, and then we have the black or the log normal vol that's currently in the market, and then we have the normal or the Bachelier vol, which is consistent with the other international benchmarks. Okay. Moving to swaptions, the underlying is the forward starting overnight index swap. And then similar to the caps and floors, that will inherit many of those features. So we have a spot lag of 0 business days. We have the South African calendar modified following backward end of month for the accrual period day generation. Just to note, the forward period and the option tenor is the same for the swaption, and so that's less than equal to 10 years. And then similarly, we've highlighted the conventions that received a lot of conversation. Right, so the exercise business days. So this is aligns to the option expiry, and so being consistent with ISDA, as well as just given the option exercise, it would require availability of the traders to be at the desk for both local and offshore. So we have the South African calendar as well as London, and then the settlement being physically and cleared. The premium type is forward. Let's make a distinction compared to the caps and floors. The premium type is forward. Over a premium lag of 0 business days. And then similar to caps and floors, we have 3 quota conventions premium with black, which is the current market convention, as well as Bachelier or normal volatility. Yeah.
Thanks, Linesh. So, I guess just to summarize, to call out a few points, and I think we touched on it earlier, benchmark assumption for the underlying CSA is that of dollars, and that's to acknowledge the fact that the vast majority of this market that plays in the space tends to be offshore and traded under $1 CSA. On that front, we felt, that to deviate from that particular dynamic would not necessarily be conducive to continuing the market liquidly on that front. And then just importantly, then on the exercise business days, we actually initially had penciled it down just on Rand business days, but when we showed the document to ISDA, they actually came back to us just to highlight the fact that generally when it comes to these option expiries, also taking into account the fact that obviously the market is dominated by offshore, or a large portion of the market is offshore, that you probably need to add London business days on that front. So the idea here is you need a trader at his desk for an option exercise, but you don't necessarily need the trader at his desk for a reset, because that gets handled by an operations team on that front. So we've touched a bit just, I guess, on the conventions, and maybe let's just delve a bit more into some of the practical side of it. So I think just to start, Pete, as a practitioner in the market, you've obviously, been part of the process in terms of setting these conventions as well. Can I maybe just ask you to give a sense of whether these conventions differ meaningfully at all from some of the other major markets out there, like US and UK as an example?
Yeah, so I think what we've tried to do is we've tried to leverage off of the previous lessons that were learned and the conventions that were adopted in SOFR and SONIA. Practically, I'd say our conventions are a little bit closer to SONIA, and I think that's mainly because our swap conventions are closer to SONIA than to SOFR. You don't have that 2 business day lag and things like that. Yeah, and I think so our options are then closer to SONIA, and I think maybe the one distinction is I think in SONIA you have on swaption exercises, a lot of it is cash settled. So ours is physically settled, but that makes it easier, to be honest, because you exercise into a swap that will reset against Oronia. Yeah, so try to learn as much as we could from SOFR and SONIA, probably closer to SONIA, and I think it worked pretty well, and in the other currencies, and I expect it to be the same for us.
Thanks, Pete. So one of the points, and I think perhaps it's an obvious point, but I do think it's worth spending just a bit of time on this particular point. So Linesh, maybe, if one looks at a 2-year cap as an example within the JIBAR space, your first reset is known. So, what you tend to have is actually just 7 caplets on that front rather than 8. Maybe just give us a sense, within the Zeronia space, why that's not the case. And as I mentioned, perhaps it's obvious to some, but I think that particular point really needs to be made, because I think it becomes apparent in a subsequent point that we'd like to make on vol.
Yeah, sure, Ajay. So maybe starting with the current setup. So we have make use of a term rate. That term fixing is known at the start of the accrual period. And to your point, Ajay, it is known. So there's zero volatility or zero optionality associated with that first accrual period, compared to something like Zeronia, where it makes use of overnight rates, and those overnight rates, even for the first accrual period, those are unknown, right? There will be volatility, and as a result, optionality for that first accrual period.
Great, thanks, Linesh. Obaid, you mentioned that point earlier about a potential payment lag. Maybe if you could just illustrate that particular point, if you don't mind, in terms of why that's actually needed in this instrument as well.
Sure. So again on screen is figures from documents that we've published by the derivative work stream. And I think the left figure is what is going to be the, let's call it replacement FRA instrument, which is called a forward starting single period OIS. And basically what the figure shows is that on the fixed leg of this derivative, you can, of course, calculate that interest rate cash flow upfront. So on the 30th of DEC, which would be the effective date of this derivative. And then the floating leg, which is, of course, linked to compounded Zeronia, we can only know that at the end of the accrual period. which in this case ends on the 31st of May. So the net cash flow that's settled, we only know at the end of the accrual period. And mainly to enable settlement, we've chosen to add a 2 business day lag for that net settlement. So you can see there's a payment that happens on the 2nd of June in this case, which is the net cash flow. And there's, of course, other ways to deal with this, like the other work streams, particularly in the cash market and loan markets, may have prescribed different conventions. But in the derivative market, we decided to keep the alignment of Zeronia as close as possible to the accrual period. And we could have solved this with fixing adjustments. And there's 3 fixing adjustments that get used a lot. So there's a lockout adjustment, which essentially forces you to use a fixed Zeronia rate for a certain period at the end of the accrual period. There's a look back, and there's an observation shift, which essentially requires you to use a lagged Zeronia rate, again, to enable you to know this final cash flow in advance of the end of the accrual period. So we've chosen this 2 business day lag, and the figure on the right just shows in general the settlement cash flow on a caplet. Yeah, so I think that's the payment lag.
Thanks, Obaid. So earlier on, we touched just on the point on the joint business holidays, Joburg and London holidays, to determine the expiry date. I just want to maybe ask Pete, if you don't mind. I think, I made the statement that a trader needs to be around for an option exercise. So I just want to check with you in your practical experience. Does an option trader actually need to be around for this exercise? And perhaps just give us a bit of a practical flavor of maybe exercise has gone wrong in the market if that's, not the case.
So the docs they do provide sort of documentation around automatic exercise. In other words, if you own an option, it's deep in the money, and you miss the exercise, I don't think you would lose the value, if that makes sense. I guess the best way to explain this is by a war story. So like a good example is in December 2017, just after the ANC conference, the market was rallying because Ramaphosa had just started. I remember the weekend before Christmas. Christmas was on a Monday, I think. So the weekend before Christmas, I was short 2 strikes. The one was at 7 the figure, I think, and the other one is at 696, and I think the swap market closed at 701. So I went into my Christmas weekend earning a lot of theta. Then market went lower on Wednesday morning. Sort of at the time of exercise, it was at 98. I thought this is amazing. 4 days of theta, I'm going to get exercise on the receiver in one swaption and the pair in another one, and my risk isn't really going to change. And at exercise, the guy phoned me. He's like, I'm exercising both receivers. You must have just not had confidence in the liquidity to get out of the payer leg at that point in time. So I guess the point that a trader needs to be at the desk for an expiry is sometimes there are considerations that are more than economics. It could be liquidity, could be the risk that you want on your book. And I think that's basically the point. The point is that it's not a reset, so it's not something that resets and someone pays cash or receives cash. It's a physical decision around the risk if you are close to strike. I think that's why ISDA said we needed to adopt the dual calendars.
Thanks, Pete. So, in addition to that conventions table that we articulated earlier on, quite a bit of work has been done in the paper to articulate conventions on, converting vol to price and vice versa. So, Tom, maybe just over to you to maybe just, give this audience a sense of those pricing conventions that have been articulated in the paper, please.
So, thank you, Ajay. Obviously, we've mandated 3 different quote methods.
generally the market is going to trade on premium. But historically, in the South African market, we've also quoted black vols. But what we've done is that we've also suggested that we move to allowing bachelier vol quotes. And the reason for that is twofold. One is that the international market is now quoting on bachelier vol for various reasons. Do you want to give me the other mic? Okay. Thank you. So the international markets are now quoting on bachelier vols. And the reason for that is that obviously in low rate environments, there is the chance or the slight possibility of negative rates. And so we feel that we first of all want to have the ability to quote bachelier vols for the international markets, but also it future-proofs the South African situation in that if we do experience low-rate environments, then we have that quoted. And I guess really the thing about implied volatilities, there's a very good quote by Ricardo Rebinato on implied volatilities, is that it is the wrong number to put in the wrong formula to get the right price. So obviously we don't believe that, if we use the black vol, that rates are log normal, or if we use the bachelier vol, that the rates are actually normal. What we're doing here is we're using those two approaches along with the market conventions to give indicative volatilities using either a log normal or a normal volatility. So on this slide here, I've just indicated why it's good for us to future-proof and have the black and the bachelier vol quoted. If you have a look on the left-hand side, we've got a high rate environment. And what I've done is I've assumed that some rate maturing at time t is distributed either normally or log normally. Those two distributions have the same mean, and they have, in fact, the same realized volatility. You can't really distinguish in a high interest rate environment between normal and log normal rates. But when you get down to low rates environment, on the right-hand side, you see that the log normal distribution doesn't allow any probability of negative rates. And so this is why in the international markets, in a low rates environment, they are using normal volatilities, is that you can see there's a small red piece over there that indicates the probability of negative rates. Okay, so what we have then done is, so I'll make a small remark as one of the few academics here. I couldn't resist putting some formulas on the screen. I had to do it. But I won't give a lecture on it. Obviously, those market participants will know the black formula, so I'll just flash through that. Of course, the bachelier formula, slightly different. It does assume normal rates, but in some sense it has similar features using the normal CDF and PDF. Of course, in order to quote these vols, we also need to indicate how the swap rate is computed. And again, I won't go into too much detail here, just other than to say that in order to compute the swap rate, we do need the indicative Zeronia rates, but we also need a discount curve. And that's particularly important because of some of the issues that have been mentioned relating to CSAs. On the caps and floors front, obviously a different formula, but again, you need both the rates as well as discount rates. So I think what we have done is we've taken all of these formulas and we've put them into a handy spreadsheet to indicate how these conventions along with these formulas allow you to convert between premium and the corresponding black and bachelier vols.
Tom, do you want to maybe just take everyone through that spreadsheet quickly before we go?
Absolutely. It might be a bit difficult. Can you just hold that for a moment? All right. So obviously this spreadsheet is available, and I'm not certain if that was sent out in the pack that you mentioned, Jay.
I don't think it was sent out, but certainly when we publish the paper, this will be published as well.
Right. So what we've got here is all of the market conventions coded up, along with date conventions, etc. What you can do in the green here is indicate, in this particular case, the parameters for your cap and floor here. So we have a 10 January 24 cap. It's a 4-year cap at a certain vol. And of course, in order to interpret this volatility, you have to decide whether it's a log normal or a normal vol. So in this case, we can say that it's a log normal vol. And that in turn, gives you a price. In this case, this particular rate gives us this price over here. Of course, if you had a price, let's say, you were seeing the following a price on a screen, you could also find the corresponding volatility. And all we're doing there is we're backing out the volatility that gives us that premium using the log normal convention, i.e. using the black convention. Of course, we could change this to the normal convention, and you can see you get a vastly different price. You'll notice that log normal and normal vols have a different size associated with them, a different quantum associated with them. But of course, that is down to the convention itself. Of course, underneath here, we actually compute all of the reset dates, all of the accrual periods, the corresponding ingredients that make up the price. Similarly for swaption, I won't go through that in any great detail. Similar situation, you put in your parameters, and then you can obviously price using those parameters and the vol, or you can indicate a price and back out a volatility.
Great, thanks, Tom. So, there we go. So maybe just, I guess, on the spreadsheet, I guess a fair amount of deliberation within the working group in terms of whether this is, was actually necessary as well. After all, I think, many of the banks can actually price this pretty easy. I think the point on developing the spreadsheet, much like we did on the linear derivative spreadsheet as well, is that the idea is to make the market more accessible faster on that front. So, if there's any sort of end user out there who perhaps, traded the equivalent Java instruments on that front that subsequently needed to check pricing, etc., in terms of the equivalent Zeronia instruments, this spreadsheet, I think, provides a very good sort of guide and check on that front to get implementation from the non-bank end user, actually, up and running in a faster manner. So it's all, I guess, in the name of market development that we've gone this extra route. Tom, thanks for taking us through, I guess, the pricing dynamics. Maybe just back to Obaid. We've, I guess, frequently mentioned this point about an appropriate discount curve. So I guess just in your capacity as, I guess, head of quants, I'm sure you've come across this point quite a bit as well. So maybe just give us a sense for everyone, just in terms of appropriate discount curves to actually use within any sort of pricing framework.
Sure. Yeah, I think this goes back to the point regarding the benchmark CSA. So just to reiterate something that Pete mentioned earlier. So this market is not centrally cleared, which thereby has many impacts. The main one is the cognizance of credit risk or counterparty risk. And of course, if we were doing this pre-2008, where the set of IBOR rates were considered to be good proxies for risk-free, and the set of banks that were highly rated weren't considered to be credit risky or materially credit risky, we wouldn't have to worry about the concept of benchmark CSA. So, the role of the CSA in general is to eliminate the need for the interbank market makers in particular to consider idiosyncratic features such as CVAs, for example. So the natural benchmark CSA would have been a ZAR-based one, which would then mean that, a CSA really defines a protocol for, let's say, margin exchange to eliminate or reduce counterparty risk, and thereby the natural remuneration rate for this margin of collateral would have been the Zeronia rate itself, and that would thereby imply that the correct discount curve would be the Zeronia zero curve. So this requirement to switch, I guess, CSAs to be one that's based on USD, which, as Pete explained, really reduces a lot of the market frictions and enhances liquidity. That means that essentially we're changing this margin or collateral settlement currency from rand to dollars. So there's an exchange of currency. And one could consider it quite naively and just consider the change of currency, and thereby it means a change of discounting from Zeronia to SOFR. Or if you want to think of it in the context of the basis market, it would mean discounting using the ZAR basis curve. So it could be as trivial as that. And I think, as Pete mentioned, for very short tenor trades, the impact of this is really negligible. But for longer dated transactions, one should really think of it as incorporating new elements of risk into the ZAR framework. So we're introducing USD, we're thereby introducing an exchange rate and the ZAR basis curve as well. So it really comes down to how one chooses to model this, which will ultimately manifest this adjustment of CSA. And I think it's more material for longer dated trades. I think that's the summary.
Thanks, Abed. Maybe just sticking with you just on that front, in terms of a vol surface, converting from, I guess, a dollar CSA vol surface to rand CSA vol surface, if one had to undertake that exercise, is that something that's trivial?
Again, I think for shorter dated contracts, it's potentially very trivial, but for longer dated contracts, one needs to be careful. And unfortunately, it is model dependent and highly dependent on how the specific market maker chooses to understand the interactions between ZAR and USD risk, right?
Okay, all right, thank you. Tom, maybe back to you. One of the points that came up in terms of option pricing within the Zeronia space is this concept of volatility dampening. Can you maybe just take us through that particular concept to give everyone a sense of what that means?
Yes, so I glossed over it here, but there is an option here to do a vol decay. And this vol decay really indicates what happens to the volatility during the period of the fixing of the rate. So what I did, just to give an illustration of this, is to do a quick simulation and show you exactly what's happening here. So ultimately, if you think about it, here are your overnight rates. I'm using a short rate model, so the overnight rates are in an upward sloping curve over here. But you have your risk-free rates, which average those rates in arrears. And correspondingly, what you can then do is you can look at the volatility of those risk-free rates. Now, what you will recall from previous conversations here and in the other session is that the first rate under a JIBAR situation would actually have a volatility of 0 because it fixes at the beginning. But of course, now that the RFR is fixing in arrears, there's actually some volatility associated with that. But because it's progressively fixing in the last period, it doesn't have the same volatility characteristics as the rest of the caplets or the rest of the RFRs underlying various caplets. And so for caps and floors, there is a suggestion that we should dampen the volatility associated with that last period of fixing. So remember that in a black and a Bachelier formula, you're putting in a flat vol, one vol that governs all the caplets. What we're seeing here is that it's very markedly the vol characteristics of that rate that's fixing is very markedly different from the vol for the other rates, and hence there is a suggestion that instead of using the flat rate for that fixing period, that we dampen the volatility. I hope that explains it.
Thanks, Tom. I've been asked to sort of hurry up in terms of time. So I think, I think there's a few points maybe to cover with, I guess, the panelists. But before we do that, maybe let's just give a chance for, I think, the audience to pose any questions in terms of conventions, etc. Okay, go for it.
So, in your model, you assume that the underlying compounded ammonia, right?
Yes.
That means in calculation of the curve formula, that then the formulas will also change. So I failed to capture your F in the cup formula. Can you just go back?
Okay.
Yeah. No, yeah, that F.
So this F here is just whether or not you're using the log normal or normal. Of course, the rate, the risk-free rate is the RIT here. Now, of course, these are going to be things that are stripped from a curve, right? But of course, those are an input, and once you've got those inputs along with the corresponding discount curve that we've talked about, then it's a straight formula. Okay. There is, again, one small complication in that in this paradigm, of course, there's one extra caplet, and that is the caplet for the rate that's fixing in arrears. As mentioned, if you think of a one-year period, there would have previously been 3 caplets for JIBAR, now there are 4.
Thanks, Tom. Any other questions? Okay, so straightforward, right? Okay, maybe let's just move back to the panelists. Maybe Pete, I think the point on starting up this market is important. Maybe just give us a practical sense of how you envisage this market, the Zoronia-based option market, to actually incept.
So I can maybe use the Sonia example again. What happened initially was that guys were market making Sonia vols as a spread to GBP LIBOR. These spreads then basically, once established, had a one-to-one relationship. So if the one surface moved, the other one moved as well. Then as soon as people were confident in the Sonia levels, that market then started to develop by itself. And it sort of flipped around where now, because GBP LIBOR had less liquidity essentially, but you still had a need to roll into expiries pre-succession, you still had that one-to-one relationship, but your starting point was now Sonia. And then obviously, so post-secession, everything went to Sonia. So like everything would go to Zoronia, and you would then just reset against compounded Zoronia plus the fallback spread. Yeah, I think we're probably going to do the same thing.
Thank you. Maybe Linesh, I think from a different end user perspective, you sit, I think, within an insurer that's exposed to significant amount of convexity. When you observe these, conventions, is this something that is going to work for you? And maybe just to, I guess, ask the double-barrel question, do you foresee any practical challenges on what we've put forth here?
Yeah, sure. I think overall, Ajay, the linear derivatives as well as this non-linear derivatives paper contains a lot of detail. So I think that does a tremendous job in managing the uncertainty. So I think we're off to a good start. So I think we've also ensured consistency with the international benchmark. So whether it's updating pricing libraries or valuation engines, it just makes it easier. I think on the insurance side, there will be the nature of the exposures are much more long dated and much more bespoke. And so whether you're working with an economic scenario generating ESG, what we've seen is that some of these models, specifically the interest rate models, will require enhancements. So, and those enhancements are not easy, so it will require a little bit of time. So maybe an early start is good. Specifically with more the bespoke pricing engines, so with these economic scenario generators, what we've seen is that some of these models may be maybe easy to accommodate backward-looking overnight rates, but some of them are not. So, for example, we've seen more recent work with the LIBOR market model, which is specifically for term rate modeling, had to accommodate enhancements, and these enhancements are not trivial, so it will require some time, and perhaps an early start on these models is important. I think also, specifically for the long-term assumption setting, this rate is new to this market. So both the level of rate as well as the level of vol, specifically for extrapolation or for setting up the long-term assumptions, will require some time. So I think that too, maybe experimenting with the data on the SAR website, looking at the quotes on screen, just increases that visibility. I think in the last piece there, Jay, would be over the transition, maybe the need to support two models, both a term rate model as well as an overnight model. So that's some of the complexities.
Thanks, Linesh. I think in the interest of time, I'm going to try and wrap it up. So I think just firstly, just a bit of, process. I think as an attendee to this conference, you would have received that conventions paper. Most certainly, we would welcome any comments. Send that either through the SAB or one of us as well in terms of any, burning thoughts on that front. Then just to conclude, I think it's been a substantial amount of hard work, not just, with the panelists, but I think in the broader sub-working group, some of whom are actually sitting in the audience as well. So I just wanted to thank everyone for the effort. I know it's not always easy, but I think, very well done, for the contribution towards market reform on this front. With that, I think we can leave it at that. Thank you, everyone, for the time.